the Ojai Valley Sanitation District Finance Committee meeting. And we're supposed to start at 4:30, which the clock now says is 4:30. So I call the meeting to order. And I think the next thing we need to do is pledge allegiance. Do we have to plan it for the meeting?
By all means, let's do it.
You get the delegation.
I pledge allegiance to the flag of the United States of America, to the republic for which it stands, one nation,
Under God,
indivisible, liberty and justice for all.
It's a good way to start.
A roll call.
We do not need a roll call for this meeting. I'll just state for the record that Director Quillisi and Director Martinson are present. Director Berg is our third committee member, and he is absent today.
So do we have any comments at this time? Anybody out in the electronic world?
Nope, nobody's, only person is Zach who's on the screen.
And the next thing we do is conduct our investment management meeting. And so I take it, Mr. Whaley, you're here and ready to do that.
Ready and eager.
All right. Well, I don't know exactly what form we need to do to start this.
Zach, you have the forum to, if you want to start off by doing any sort of presentation, providing any information that you want the committee to know. They may have questions for you after you're done, but the floor is yours.
Okay, awesome. I'm going to share my screen here, or at least attempt to. 1 second. All right. Just switch this right here. Okay, can you guys see my screen?
Yes.
All right. I'm going to jump right in. So first of all, thank you very much. I'm honored to be here and excited to share a little bit about McQueen Financial and learn more about what you guys are up to and see if there might be a good fit. So I know that time is of the essence. I'll jump right in. And I just want to say that the presentation, I'm happy to send this after the call. It's a little bit wordy, but I'm not going to read everything on the slides. Just going to hit the high level and then leave some time for questions and answers at the end. So do not be intimidated by the amount of words that we see here. All right, so at a high level, talking about McQueen Financial, I've been with the company now going on 10 years. I'm a senior investment advisor. I spend most of my day working directly with our clients, developing strategies, investing customized portfolios for them. And I love what I do. I have great relationships with all the folks that I work with, and always excited to expand those relationships. So when we look at the slide here, McQueen Financial, we have $9.8 billion of assets under management. And the average portfolio size that we work with is about $20 million. Now we have portfolios much bigger than that in the hundreds of millions. We have smaller size accounts around 1 million or so. But when we saw your RFP a few weeks ago, or when that came across our desk, that's a perfect size for the type of client that we're looking to work with. You guys have about $8 million. That's a Goldilocks for us. We don't focus on the mega institutions. We're really focused on organizations that we consider about, mid-sized. So we have 25 years of experience as a company. We work with 385 clients across the country, 41 different states, and I zoomed in on California here. We have 20 clients that we work with inside of California. And one of the things I wanted to point out, actually, let me start off with a question. Have you ever worked with an advisor before, or is this your first time considering working with one?
We have one.
Okay, so what is the most important thing to you and why you're considering making a change?
Say the imbalance in the cost compared to our assets under management.
Mm, okay. Getting charged too much for the amount of money that you have invested.
Wasn't always that way, but it is now.
Okay, that's good context. Besides cost, obviously that's very important. What are you looking for in a good partner that you would love to work with in this area?
Well, the investment rules are pretty tight already.
Sure.
You don't see that there's going to be a lot of creation in the portfolio, no matter who we go with.
Hmm.
So many things that we can't invest in. But we want, of course, to minimize churn in the portfolio.
Mm-hmm.
And we want responsiveness when we need it. So
Okay.
One
Very
thing
good. So,
I was disappointed with in our current arrangement, particularly about a year ago, was that, at a time when CDs were returning over 5%, we were getting about 1% on the money invested in some of our accounts. And it just seemed like advisors weren't paying a lot of attention.
wow.
And at the time, we're only allowed, I think, put about 15% of our money into CDs, but we certainly would have been, even at that, been making more in interest than we were. So if we're going to have an advisor, we'd like them to actually advise. And,
You know,
and, and part of the problem with that, of course, is, if you've got things in certain, call them instruments, financial instruments, you can't just sell those and move into something that's more, has a higher interest rate without incurring some penalties. And so, there's some issues around that we were never real clear on what exactly the problem was. But in any event, some of that's taken care of itself over the last year or two.
but while you're in that, it doesn't feel very good.
It didn't to me because my personal was doing better.
Understood. And even though CDs are part of the tight restrictions that you have within regulation and policy, that's an amazing low-hanging fruit. I mean, when you can get a government guaranteed FDIC or NCUA guaranteed investment for 5%, that's a no-brainer. Yeah. Awesome. So, yeah. Yeah. Any other comments on that? That's great context. Price is important, lack of churn, and responsiveness is awesome. Any other comments? All right. We'll make sure we touch on that. Press on. Okay. So a lot of words here, but I want to focus on the top bullet point. The very first step when we work with somebody is we have to understand your organization. It's the most important thing. So what we do is we are very proud of our communication. We start off every relationship and we discover what it is that you're trying to accomplish. So I don't want to represent that I know more than I know, but I did take a look at your master plan, and the projects that you have coming up are pretty interesting, right? It seems, if you're still on track, that there's a bit of a window here where there's not a lot of projects that were on that plan, but they're coming up in the next couple of years. So what we want to do is understand, how are you planning on funding those projects? You're going to begin in the planning stages, but then you're going to start with the actual work, and that's going to cost a lot of money. So we want to build a portfolio ladder that obviously takes into consideration what we need to per regulation, which is safety, liquidity, and yield. And within that context, by asking good questions, by understanding other sources of funding that you're going to have to pay these projects, we need to know, how is this portfolio going to help you in funding that? And we do that by building an investment ladder. and educating you. There's not a lot of esoteric stuff going on here. It's mostly government guaranteed. We can take a little bit of risk with A-rated corporate bonds or taxable munis within 5 years. But if that's something that needs education, we want to be able to educate you so that you feel comfortable within those different asset classes. And if we're not comfortable, there's plenty more to go into. But we need to start there. So understanding your goals is very important. And then we look to build a ladder and design a portfolio to accomplish that. Staying within policy is incredibly important. That's obviously what we need to do. But then on a monthly basis, delivering you reports that are easy to understand to make sure that we're tracking to those goals and continually monitoring the investments. One of the things that we do that it sounds like maybe wasn't happening before is really detailed swap analysis. And what that means, if you haven't heard that term before, it's taking a look at the yield curve is always changing. We were in an inverted yield curve environment for a long time, for a couple of years, where you were actually getting paid less money the longer you invested. You know, out to your 5-year limit, you would have been paid less yield than if you stayed short term. Well, that yield curve is now positively sloped. You're going to make more money as you go out. If we can take advantage of that in the asset classes that everybody feels comfortable with within regulation and policy, we can build a ladder to go out further to when those projects are demanding money to come back to you. That's what we want to accomplish. But once the portfolio is in place, a swap analysis, what that does is it takes a look at the other available investments that are in the market compared to what you have now, and looking at trading out of low yielding returns. If you were in 1% and we were in a 5% environment, that is the perfect time to do that type of analysis. And that's what we pride ourselves on, is not just a simple buy and hold, but actually digging down and how to modify the portfolio as we go forward. So what does that look like? On an ongoing basis, we want to have a cadence of communication. So whenever we start a new relationship, what I recommend is that with management or with the investment committee, with the board, however we want to do it, weekly meetings or bi-weekly meetings, or at least monthly. And that doesn't have to go on forever. There's a lot of folks that I talk to on a weekly basis, but it doesn't have, I don't want it to be a burden. But at the beginning, when we're really figuring out what is it that we're trying to accomplish, what is the structure of the current portfolio and how can we make it better, that ongoing cadence is going to be incredibly important so that we're all on the same page. So that communication, that responsiveness is really the backbone of what we do. We also review our portfolios on a quarterly basis, a semi-annual basis, annual, whatever is needed per policy, quarterly and annually. We can make that happen, but you're going to be receiving reports on a monthly basis. We also have daily and weekly commentary that we provide. If you're a bit of an economic nerd like myself and you want to know what's going on with interest rates, you want to know what's going on with the economy, we provide that to you on a daily basis. So you always have insight into the markets. You're never going to be surprised. You know that we are aware of the best value and we break it down by the different investments that we can buy. That is front and center. You'll always know what's out there. And then additionally, this can help with board training. We do webinars. We do webinars on the economy, on interest rates, what's going on in the world, and we do that on a rather frequent basis as well. So I'll skip this page. We talked about it a little bit. When we have a plan in place, we understand what you're trying to accomplish. We know when the investments need to come due, and now it's time to go execute. The first thing that we do is we will search through all of the potential investments that are available in the market. Okay, so McQueen Financial, we are not brokers.
Be the timekeeper. So if you guys want Q&A, then we'll have to move to Q&A. Otherwise, you can let him finish his last few minutes.
I just have one remaining question.
Zach, I have to as timekeeper so that we stay on, so everyone has the same opportunity. So we have to move to Q&A, and I think Director Quillisi has a question for you.
Oh, please.
Zach, you said you wanted to understand our organization. Presumably
Yes.
you looked at the org chart. I have to tell you that that is the organization of the future. All of the boxes on the chart are filled with people right now. And I'm curious about the corresponding thing, your company. There looks like there's 6 different people reporting to the president and then various teams under them. Are those all full of people? How big a company is this in terms of staffing?
We have 55 people at the company. And in terms of responsiveness, you would be working directly with me as senior advisor. So you would not be going to anybody on my team. I have a team of analysts, a whole credit team that supports me, and operations team. You would be going directly to me.
Okay.
I have a query. And it has to do with, well, actually, it's a statement, I think, then, because it's not something that would be readily apparent from your review of our website, our board, or the org chart for the district. And that is, and by the way, I'm William Ulrich. Known to be the chairman of the regular board, but for purposes of right here, these guys know more than I do about finance. But I would say that the culture of the board of the Ojai Valley Sanitary District is and has been for as long as I've known about it. Functionally, our capital improvement projects are paid for out of resources on hand. So from a perspective of investment performance, I think that, and correct me if I'm wrong, Allison, typically speaking, and I think that's been evident in descriptions of past advisors, and there were expectations, there wasn't a whole lot of performance in some areas that were, as you described it, low-hanging fruit.
Sure.
So I think from our perspective is get things forming as to optimally, but we don't typically pay for projects as a result of investment performance or investments themselves for that stated purpose. Typically speaking, if we have the and it's not if, but when we have the resources, and we typically do, with the exception of a couple of natural disasters that happen every once in a while, we're able to execute our CIP from assets on hand. So
The last time that we sold any bonds was 10 years ago, and that was to pay off earlier fair interest bonds. And we have been on a pay-as-you-go basis all that time.
So that's really good context. With that in mind, what do you see the primary purpose of the portfolio providing to you? Extra income, essentially?
asset enhancement, letting some of us wizened, gray-haired folks sleep better at night, that kind of stuff.
Absolutely.
We have a lot of capital projects.
Yes.
We're just going to have to work our way through it. The better our investments go, the quicker we can work our way through it.
Understood. Yeah, and in the past, have you built a strong ladder to navigate various interest rate environments? It's a very important thing, very important topic right now, with so much uncertainty with the Fed, with inflation, the direction of interest rates. Has that been a topic of conversation?
I don't think the word ladder ever entered the conversation.
No, and that's,
Wow.
we're very reliant on our advisor to do advisory things.
Well, let me tell you really quick about that. What a ladder means is you have investments that are maturing over different time frames, okay? If you have only long-term investments, that could be a problem because if rates go higher, you're not going to participate in that. And if you only have short-term investments and rates go down, all of those great investments you have today, you're going to be getting lower yields if rates go down and they mature, and you're going to have to buy new investments. If you've never had a ladder before, that is one of the very first things I think you should consider, because it can enhance your yield and protect you no matter where they go from here. And there's been a lot of volatility over the last, call it 5-6 years. Interest rates have gone from 0% to 5%, and then they're coming back down and oscillating. It's incredibly important that you build something like that.
So I think at this point, we've only allocated 15 minutes per, which
Yeah.
is probably
Yeah,
too
we're
little,
running behind.
turns out. But is there some sort of a additional documentation you can give us as far as rate schedules, fees, all that sort of thing? And I think general comments you've made are, you know, very good.
We can definitely provide you that. That was a part of our RFP with our fees. We can provide anything else. And I'll give you this presentation. Sorry,
Yeah,
it
you have that.
didn't quite get through it, but you'll see our portfolio reporting and you'll see the ladder that I'm talking about. And I want you to take a look at that. And if we have another meeting, I'd be happy to go into more detail, because that's an integral part of being able to invest strategically. It's very
Right.
important.
And Spot and I can assist with, providing some bullet points, after all the presentations and sharing them with the committee.
It's,
All right.
Okay, thank you so much, Zach.
Assets under.
Thank you very much. I appreciate it.
All right, thank you. Sorry
All right.
for the
Zach,
limited time, but thank you very much.
No worries. I hope to talk to you again soon, everybody. Take care.
Thanks.
Bye-bye.
Marcia, 4:52, just to keep everybody on the 15 minutes.
Yeah.
Robert,
yeah, Robert.
We'll note that right. up.
David.
This is optimized investment.
Mhm.
Where'd they go? Is this David,
Nichalik?
I think it's
Both of them.
both of them? Hello.
Word is here and we're ready. You have the floor
Hello.
to tell
Good
us
afternoon.
The one
folks
thing-
here.
the one thing that we do have to advise you is we're pretty tight on the schedule, so 15 minutes is probably too little, but appreciate it if you can keep whatever within that time frame. So
No problem at all. So let me go ahead and get my screen ready. All right. Well, good afternoon, and thank you for providing us with an opportunity to share this presentation with you. I'm Robert Mikulik, Chief Operating Officer of Optimized Investment Partners. OIP is a California municipal investment advisory firm exclusively focused on small and mid-sized public agencies. Joining me tonight is our CEO and President, David. And before I dive in, I just wanted to acknowledge something the board may not be fully aware of. We've been working closely with Scott since December 2024, well over about a year and a half now, of regular interaction with Scott and the team. So tonight isn't a cold call pitch from an unfamiliar firm. We already know the district. We already know how Scott thinks about cash management. And what we're proposing is to formalize that working relationship into a true advisory partnership. So over the next 10 minutes or so, I'll cover 6 things: a quick introduction, where the district stands today, our investment approach, our 2 core differentiators, cash flow modeling and cash management, and what that really means in concrete value to the district. We'll close with about 5 minutes or so for questions. I'm going to go ahead and share my screen at this point in time. If you could just confirm that you can see that okay?
Yep, we got it.
All right, fantastic. All right. So before we talk about what we do, I want to ground us in where the district actually is today. These numbers come from the district's March 2026 quarterly investment report. The portfolio has about $7.7 million. About 78% sits in camp, a high quality pool, but it has variable interest rate. When the Fed cuts rates, the yield resets within weeks. The other 22% is in a managed ladder, but the duration is only 0.67 years, And that means the average bond rolls over in about 8 months. So that piece protects income briefly, not for years. Now, here's what this means in dollar terms. CAMP is currently yielding around 3.76%. A true laddered portfolio in today's rate environment could be yielding closer to 4.2%. That difference, about 44 basis points on roughly 80% of the portfolio, translates to real additional interest revenue every year with no added risk. The point isn't that there's anything wrong, it's that there's no long-term income protection in the portfolio, and there's measurable yield being left on the table, and that's the gap we exist to fill. And it's actually very common, a very common position that we see when we start with most new clients. So this is how we think about the difference between
Ladder with one rung.
What was that?
I say we have a ladder with only one rung.
Yes, a very narrow rung. Yes. So this is how we think about the difference between a typical municipal advisor and what OIP brings to the table. A typical advisor is built to serve many client types. Public agencies are one of many segments. Strategies tend to be standardized across the book, and many are affiliated with pool products, which creates a structural conflict. They may be recommending tools they themselves manage. OIP is set up differently. In fact, OIP was founded specifically to serve districts like yours, small and mid-sized California public agencies, including special districts, that are often overlooked or underserved by traditional advisors who focus their attention on larger cities, counties, and agencies. We're squarely in your wheelhouse. We work only with California public agencies. We build cash flow modeling and cash management for each client. We're not affiliated with any product or pools, and our government expertise comes through David. He served as a finance manager at multiple California cities before becoming the finance director and treasurer for the city of Chula Vista, where he transformed a $300 million portfolio, and reporting and compliance support is included, not extra. These aren't marketing claims, they're operational differences and how we're built. So this is what we believe is our secret sauce. Most advisors will ask you, the district, how much would you like to invest? And the district typically tends to give a conservative number based on what feels safe. We don't do that. We start by building a detailed cash flow model, analyzing your historical revenue and expense patterns, your budget, your CIP programming, and your current financials to find the actual timing of cash flows within your fiscal year. The chart on this slide is from an actual OIP client. The blue line is the cash flow model. The red line is roughly what a typical advisor would invest. The gap between them is the money that didn't need to be sitting idle and the additional revenue that came from putting it to work. Important point. This approach doesn't take away from your operational liquidity. The whole purpose of cash flow modeling is to figure out exactly which dollars are truly investable and which need to stay liquid for operation and really any unexpected expenses the district might experience. We're not moving funds you need, we're putting the funds you don't need to work. And as David likes to remind us often, it's not what you invest in, it's how much you keep invested. So translating all of that into what it means for the district specifically, we like to think of it as 3 pillars of value. First, cash flow modeling typically identifies 30 to 50% more investable funds that can be safely structured within the portfolio while preserving same-day and near-term liquidity for all of the district's operational needs. Second, strategic laddering creates stable, predictable cash flows that support budgetary planning while reducing your exposure to interest rate risk. Third, Active cash management is what unlocks the found money. The proactive approach often reveals substantial amounts of underutilized funds that traditional advisors miss, creating significant additional revenue without adding any additional risk to the district. The combination is meaningful. More investable funds locked in at longer term yields with active oversight that keeps the portfolio working. So we spent some time talking about duration and laddering. This slide is the historical proof. This chart shows 10 million invested in 2002 across 3 investment types. In blue, 1-month treasury notes. So this would be comparable to CAMP. In orange, LAIF, and in green, 5-year treasury notes, what a real ladder would typically hold. 2 things to notice. After the 2008 financial crisis, short-term yields fell essentially to 0. The 5-year ladder fell less dramatically and kept paying. In 2020, during the COVID pandemic, the same story, sharp collapse in rates, the ladder produced more stable returns. The takeaway, recessions are unpredictable. Once they start, you don't have time to readjust the portfolio. A laddered approach delivers steadier, more reliable interest income across all rate environments, especially the low rate periods. So that's the heart of what we bring to the district. We're happy to take your questions and talk about next steps, and just really thankful and grateful for an opportunity to meet with you this afternoon. I'll open it up.
Your chart there showed that laddering 5-year maturity investments was a better idea. How does one get there if the current investment horizon is under a year, where we are currently invested? We can't,
Sure.
if we start buying 5-year notes, which I would not disagree is a good thing to do, how much of that can we do? Or do you take, say you want to invest 80%, and we'll take 16% in each of the next 5 years and buy 5-year notes, and that's how you'd ladder it? Or give me an example of what you would do.
So on day 1, typically what we would do is we would assess how much liquidity you need over the next year, and we'd ensure that we have a buffer on top of that. But let's just use averages. We typically can get at least 80% of your total funds in a 5-year ladder. So you described it pretty well, actually. 16% in 0 to 1 years, 1 to 2. So we wouldn't start with buying all 5 years. We'd start with buying 1 and 2 and 3 and 4 and 5-year investments at about 16%. And it would be aligned up with the months that you need liquidity the most. So we'd keep a good chunk in checking, a good chunk in liquidity making money, and then the rest would have a 5-year ladder. Once that's built, and this environment's pretty good to build that because the yield curve is still kind of flat between 2 and 5 years. There's only about a 20 basis point difference. Sometimes that stretches to 50 to 100 basis points in a normal environment. So we would in the future be reinvesting those maturing investments in 5 years. And we gave you the conservative numbers of treasury notes. If the district is open to CDs or corporate notes, we can exceed the rates of return on that chart that we gave you.
Okay. Can we live, just for staff, can we live with remaining 20% plus 16 coming in a year? Is that enough for our cash flow?
I don't know. I mean, we're going to have to sit down and do the cash flow analysis, or they can do the cash flow analysis. We're going to be obliged to give them a report of what we can do and when we can do it.
Timing is important.
The timing is that is the
Yeah,
important.
that is really the most important thing, and we have some control over that. We're in a pretty good cash position right now, so it's as far as we ended our last
Might be okay.
our last tax roll with some excess, revenue just based on cash flow fluctuation. And so we're actually sitting pretty good. So we have some flexibility wise.
This is my first public agency, but I've worked for large and small commercial companies. And I know one of them needs a profit margin and the other one needs cash flow. I think we're more toward the other one needing the cash flow. So a cash flow analysis, good management there, and building a ladder sounds like good stuff to me.
We, of the 30 plus clients we have right now, we've never once had to sell an investment prior to maturity due to the way we build out that cash flow model. So we have a proven track record in building these out accurately. And it's a living, breathing model. We're going to be talking with the district at least on a monthly basis. So we'll get ahead of any budgetary surprises, any deviations, and we'll update that cash flow model to ensure we're taking proactive steps to make sure the district always has plenty of liquidity. And we do that across all of our clients today.
I've exhausted my questions, Chair.
It's exhausted. I don't have a question. Do you, Bill?
Nope.
Thank you so much.
Thank you
Thank you
very
very
much for your time. Appreciate it.
Take care. Goodbye.
Next two people are here.
It's Jeannie and Justin.
Jeannie and Justin.
I ask a question before we bring the next person in. When I was looking through the rates, the green is like 1.9. Last ones were 0.10 for our. Now we're paying close to 1%, aren't we?
Or we have a $25,000 a year minimum too.
That's 5,000.
That's
So that's almost
the sticking
twice.
point.
But
Is there's
over twice what these guys are
the
saying.
rate is low, but the minimum is high.
I hate when that happens.
I hate it when that happens. Yeah, because at some point, you know, if we're really only earning 1% and they're charging 0.5% to manage it, it's just silly. Which is why we're here. So has that group that's working with us now come in with kind of a,
That's their floor. They don't go.
No, but this is one of their sister, this next group right here is their sister group. So this is US Bank, which is a sister group to PFM.
The subsidiary of US Bank.
And I don't know, I'm not sure who owns who.
I think it's the wealth management company for the custodian of the funds that sit in PFM, if that makes any sense.
That was very technical.
go
I
ahead.
was like trying to think of how to connect the dots.
Bring the next folks on.
There. Hello.
Thank you for attending this. We're running a little bit late, not too bad, but one thing, we are on kind of a time crunch here, so we need to hold this to about 15 minutes if we can. But anyway, you have the floor. Please proceed.
Hi, well, I'm Jeannie Abraham. I'm the private wealth advisor here at US Bank Private Wealth Management. It's a pleasure to meet you all, and we appreciate the opportunity to present to you. Can you hear me okay?
Yes.
Okay, great. Well, I serve as the relationship contact. I'm fortunate to have a team of experts that work with me, and one of them being our portfolio manager. As an Ojai resident, I value the opportunity to work with local organizations, so thank you. So while Justin and our investment team are responsible for the investment management oversight, I serve as the day-to-day relationship manager. So my role is to coordinate, to make sure that all of the services that the bank has available are available to you, that, trust services, treasury management, lending solutions, and just offer ongoing support to make sure that we have all the expertise and services that the bank has to offer available to you to meet your objectives. So it's my pleasure. Today, I know most importantly is my investment partner, Justin Dorn. He's a certified financial analyst. As I mentioned, portfolio manager here at US Bank Private Wealth Management. He's responsible for portfolio construction, investment strategy, risk management, and really the ongoing oversight of our portfolios, public and institutional clients. He brings a wealth of experience managing fixed income portfolios, and he'll walk through our investment philosophy process and how we would approach managing the district's assets. So Justin, I'll hand it over to you, and thank you for being here.
Hi, folks. Good to see you. Scott, nice seeing you again. We thank you very much for the chance to chat with you today about the fixed income portfolio for the sanitation district. If you'd like, I can put a few materials on the screen. We did send out some. Let me know if you'd like us to briefly go through those or just keep our discussion high level.
We have your briefing from the proposal.
Okay, great. Great. After talking to Scott and getting the RFP, it's our understanding that the sanitation district is looking for help managing a high quality fixed income portfolio. And that's where we come in today. I know previously you've been working with PFM, which is part of US Bank, and they are looking to change platforms. So today, we would be talking to you about not a change in necessarily service level, but just a change in platform. As Jeannie mentioned, we are part of the private wealth group here at US Bank. So we work with high net worth individuals, foundations, endowments. We do work with government agencies as well. And so this is very much what we do. It would be just on the private wealth platform. I think you saw in our note that the fees would remain the same. You would still have the same access to our credit research, our investment oversight, our research capabilities. It would just be delivered, and I think this would be a plus, by a local portfolio manager. I'm based in Santa Barbara. I'm a senior investment portfolio manager with US Bank. I've been with the bank for the last 13 years, and so it would be a nice local presence. We're just right down the road from you, so we're able to meet with you as often or as little as you'd like. But again, no real change in the platform. As you might have experienced with PFM, the goal of our investment management is to have institutional capabilities, centralized research that we deliver on a customized basis to our clients. And I think depending on the sanitation district's needs, we would help put together an investment objective statement that would guide how we invest. We would manage specifically to that. And it would be delivered locally by me. So nothing stuck on a model, not in a commingled fund with other investors. It would just be for the sanitation district and no other investors. So we could very much customize that as much as necessary. You'd still have the same institutional research and capabilities. In fact, the private wealth group and PFM share resources and are really part of the one US Bank approach to managing investments. Our investment philosophy, we're data-driven in our decision-making. It's not left up to me as the customized portfolio manager to go out and choose, whatever investment might be in vogue at the moment. It's data-driven with our centralized institutional team. We're very process-centric in our discipline. We have a whole team of credit analysts that review, any investment that we make. And it's my role as the local portfolio manager to make sure that I'm hearing what our clients need and making sure that the actual specific investments align with my clients' objectives. So it's a very robust process. It's, data-driven, repeatable. It's, depends on what's going on in the economy. We can take an active approach, provide our feedback on what we're seeing in the market, where opportunities and risks might lie. And if we have some flexibility in our objective, we can fine tune the portfolio to that. It's our understanding that historically, it has been treasuries and agency bonds. We would propose to continue doing that. We also have the capability of adding investment grade corporate bonds, which again comes with a very strong layer of credit analysis from our credit team. The treasuries would represent safety and liquidity, so kind of a core foundation for the portfolio. The government agency bonds provide incremental yield enhancement. And then, depending on if we needed it, the corporate bonds add an extra level of diversification and even further incremental yield. And I think if we were to work with you, we would fine tune that based on any investment guidelines you would provide and through ongoing engagement with you until we had a customized portfolio that fit your needs. On the portfolio alignment, obviously maintaining compliance with the sanitary district's investment guidelines is of critical importance. So we have the tools and the mechanisms in place to make sure that if you give us a set of criteria, whether it's a maturity range or a minimum credit level, we would have active ongoing monitoring of that. We would be able to manage the portfolio within those guidelines. If something changes, let's say a bond got a credit downgrade, we can quickly act on that to make sure that we still maintain compliance with our investment objectives, that we don't take on additional risk. So that ongoing management of risk and portfolio compliance is central to what we do. All of the reporting that we provide is very transparent. We can provide quarterly updates, even monthly if needed, that talks about what the income has been, what the credit rating has been, what the liquidity profile looks like. I know that potentially there may be some needs for these funds in the coming years, so we can talk about managing our maturities so that if those funds were needed, we would have ample liquidity ready. We can also balance that with kind of rainy day funds that need to be available but might not need to be readily accessed in the next few months. And so we can make sure that we're optimizing the return there. But I just, to summarize, our role is to help the district prudently manage a high quality fixed income portfolio. We want to deliver with a disciplined investment process, which I think you're accustomed to with PFM, maintain capital preservation, keep the liquidity up, provide a healthy income stream, and do all of that within the context of your investment policy statement. So we have all of those capabilities. I think transitioning from PFM to private wealth is just a different platform or a different means of delivering the same investment results that you're probably used to. I'll leave it at that and be happy to open it up for discussion.
Anybody have a question?
I do. I noticed in the proposals that we received, yours was clearly broader in scope than special districts. I did not see a fee schedule. And I think what you said was your fees are the same as PFM?
That's accurate. Yes, that's correct. Yes.
Percent with a minimum of 25,000.
Our fee schedule is 0.4% with a minimum of 5 million. We were under the impression from PFM that is the fee that they were charging as well.
They were charging 1/10% with a minimum of 25,000.
The same number.
Yeah, that is.
Or for the first.
Was it 25,000 or 25 million potentially? I know that part of the challenge was that they have certain account size minimums, and I think that the district's portfolio balance had fallen or remained below that, and so that is part of the issue with PFM.
50,000 at that, 4 through 5
for 5 million.
So it's the same number. 1% is 50, so they're charging us roughly a half. 7.4, but that's.
Okay.
I think
look.
on the fee discussion, it's worth pointing out that we are not compensated by any commissions. We don't mark up any of the trades that we do. I think if you've seen in our deck, we adhere to a fiduciary standard, which is a little bit different than the suitability standard of the brokerage world, where they might say no commissions, but they mark up the bonds and make a spread, which encourages them to have more transactions. For us, no commissions on transactions. We operate an institutional fixed income desk and are able to interact with the market and pass on all savings to our clients. The investment management fee is on the assets under management, and we believe that aligns us with our clients, where we want to see our clients keeping as much money as possible. And so therefore we're incentivized to minimize any transaction costs because it helps you and it helps us.
Okay, well, I think hearing no other questions, we're kind of, like I said, we were bound by time here today. So again, we appreciate you coming and showing us what you're doing and how it would work.
We're talking to PFM's big brother.
Yes,
nice.
that's right. Yeah.
We here in Ojai. It's
yeah, you got the big brother there that will meet with you locally, and our availability is much more flexible because our day job is either managing investment portfolios or meeting with clients. That's all I do in my role. So anything you need, we're available for you. We have the ability to go very customized. Again, I think PFM was kind of commingling funds, which generates a great return, but if that's not exactly the profile that you're looking for, it may be nice returns, but not the strategy you're looking for. So we can absolutely custom tailor something to your exact needs, whether that's on liquidity or return or whatever that might be. So you get a lot of flexibility here, hopefully an even more personalized touch than PFM, and still within the same great institution.
all right. Well, thank you.
Thank you so much.
Thank you for the
Very
time. Good luck in the meeting.
For time.
Bye-bye.
Trial and error. You learn.
Hello. Thank you
Hi.
for coming. We apologize. We're running a bit late.
Oh, no worries.
Don't worry, team. We're here for you.
Good evening. Nice to meet you.
Well, thank you. The board is here. We've got a little more time with you. We've been trying to hold it to 15 minutes, but we can run over a bit since the time is what it is right now. But anyway, you have the floor.
Well, team, thank you so much. And I'm Gilbert Garcia. I'm the managing partner here. And with me is Ruby Dang, and she's the historian. I joined here in January of 2002, and Ruby's been here 31 years.
Yes, I have.
And so, she's seen everything and she's done everything. And what we'll do is, with your permission, is I was going to give my background, and then I'm going to kick it to her. She's going to give her background, and then she's going to start at the beginning of the presentation. And hopefully all of you have received this presentation.
Yeah.
Yes.
Okay, wonderful. So we can either share screen or we'll just talk it through. And we'd rather this be a conversation than really page 1, page 2. She will go through essentially some things about the firm because I think it's important. I know a lot of this is in the RFP and the answers, but nevertheless, we just think it's important to really know who we are because, we're in your shoes in many places. I was on the pension board in Houston. I was on the pension board at Dallas Fire and Police. I was chairman of our transit agency where I appointed all the trustees to our pension board. Ruby got P&I's, wonderful female executive of the year.
Most influential.
Most influential. She was, she.
The honorary a group of P&I's most influential women, which is such a great honor. That happened in 2023, and I'm happy to say they appointed me to their advisory board. So I'm now on the advisory board as well, hoping to introduce more women to the industry.
And she was and is on the investment advisory committee of Texas Employees Retirement System. And so where I'm going is we understand the assignment. And I would frame it this way as I see it is most importantly, don't mess it up. Don't hurt the client. Don't blow up. Don't, invest in something you shouldn't invest in. Don't do something that's out of your wheelhouse, that's out of your core competency. I mean, I think we kind of really get it. And so just know that. And in my view, if I were sitting in your place, I would say, well, is this a firm that does all kinds of things to all people, or is this their core competency? And you're going to hear from us as we go through our different client types, our different types of mandates, as we go through the partners, as we go through what we buy and what we don't buy. You're going to see it really matches up with your Exhibit A, because we do nothing but high quality securities, and I'll go through what that means in a moment. But my background is I'm a native Texan. I'm first generation college. I'm all of that story. And my first big break is I went to Yale. And my second big break is I had a summer internship that put me at Solomon Brothers in my summer between my sophomore and junior year. And I'm dating myself, but that was the summer of 1983. So I saw the birth of all the products that we take for granted today, whether it's a mortgage-backed securities market, whether it was
AT&T.
Yeah, I mean, everything. I've seen it all. I saw the birth of Bloomberg, the birth of the asset-backed securities market, all of these things that we take for granted.
The Liar's Poker.
The Liar's Poker folklore, which I could say it's almost all true because I lived it, I was there. And so it gives us a really interesting perspective, because until you really live through things, you don't really know. You can read about things, but when you live through them, you have a different perspective, I think, which brings significant value to the firm and to people around us. And I then worked full-time at Solly for almost 6 years, and I had the opportunity to return back to Texas because I was in New York. And I joined former Mayor Henry Cisneros to start a money management firm. So I went from selling bonds to buying and managing money. And I've been on the buy side really since 1990. And I joined our firm in January of 2002. And at that time, the firm was an equity firm. And at that time, the firm had already sold themselves to a big conglomerate called AMG that buys money management firms. And when I arrived, we were only 200 million in fixed income assets under management. And that, again, was in January of 2002. I was made a partner in 2006. And right around that time, we were really struggling on the equity franchise because we were an equity firm at the inception of 1988. And then I became the managing partner in 2008. And at that time, it was really clear we were changing to a fixed income firm. In other words, we're not a consulting firm. We're not a muni bond firm. We're not an equity firm. We do one thing. We're the Kentucky Fried Chicken of money managers. We do one thing. There was an old commercial that says, we do chicken. For us, we do fixed income securities. And that's what we do. And then I was made the managing partner in 2008. We crossed 1 billion in 2009. And then here we are today. We're right just under 25 billion. It's been a glorious trip. And I would say when people say, what's the secret? The secret really is the people, because we don't have patents. We don't have any sort of inventory, anything. And people like you on the other side, really what you're hiring is the people. And do you have a good feeling about them? Do you trust them? Do you understand their process? Because performance will come and go. It's really about making sure you don't get hurt. And so now we're almost 25 billion, and we've been extraordinarily stable in our firm. And you'll see we've gotten, I won't go through them all kinds of awards, from best places to work, almost 10 years in a row, emerging manager of the year, all sorts of awards. We can't even keep up because they're all important, but we want to win the next award. I'm now going to introduce Ruby Dang again, and she's been here for 31 years. Ruby, take it away.
Yeah, so good evening, everyone, and thank you so much again for the opportunity to present today. So as Gilbert mentioned, I'm Ruby Munoz Stang, and I am the historian. I have just celebrated 31 years with the firm. You know, born and raised in Houston, product of public schools, of graduate of the University of Houston, and this has essentially been my only career. I started in operations, and I always have to tell folks that's when it was a T+7 settlement. And as you know, we're now at T+1, going to probably just a T0. And I've had the fortunality to be able to work in every department. Started in operations, made my way over to the investment team, and then in 2008, when, as Gilbert mentioned, as we were transitioning from equity to fixed income, at that point, because I knew our clients, I knew our systems, I had some background in the markets, I launched our marketing and client service department. It was a team of 2, and now I'm proud to say it's the largest team where we are now at 16 partners, or 16 team members. And as it relates to the firm, again, as Gilbert mentioned, we are located in Houston. All we do are high quality fixed income portfolios. We are managing about 25 billion. We have 41 employees. We're all here in the Houston office. We really believe in being together and being just in one office so that the communication is so important. Not only are we in this one office, but we're also located on an open trading floor. If you look at page 2, I think this is a good way to look at our assets as well as our clients. So if you look on the 2 pies, you can see it by type. You do see the aggregate strategy. We have 57% within that strategy. But if you were to have looked at this just a few years ago, it was closer to 80, 90%. So we've done a really good job at diversifying, including introducing some cash, 1 to 3 enhanced cash products. We have under that strategy, those strategies, about 4 billion. And if you look at the client base, you know, again, it really does mirror our our types, because at one point we also had almost 90% of clients that were public funds. Have done a really great job at diversifying there as well. As you can see, that is now only 56%. If we look at page 3, back to Gilbert's statement, you are hiring the people. And if you were to look back at the firm, you know, at one point, Gilbert essentially had 100% of the ownership when we transitioned. But he recognized that he wanted to be part of a bigger, something bigger, and he wanted to share that wealth. And he has been true to his word. As you can see that we are now 16 partners strong, and there is partnership within every department of the firm. The 3 departments: investments, client service, and operations. And we believe in partnerships, which means you have to be fully transparent. So you can see underneath every partner, not only their tenure with their firm, the industry, but also the percentage of ownership they have, as well as when they became a partner. Every partner is subject to the same partnership agreement. And what we've learned, regrettably, through other folks having to close their doors, is that you have to make sure there is a buyback clause within your agreement. So we have that in place. No matter when you leave or when you come in, there is a set book, essentially a book value for the ownership, and it's financed over 3 years by the company.
Okay.
I think go
I
ahead.
think what you've done is given us a tremendous background on what's been a very obvious success as a corporation. What we're interested in is how would you deal our type of investment where it's a public agency. We don't have a lot of flexibility. We have certain amounts that we have to keep in reserve. We can only invest, for instance, in CDs up to 15%. But primarily interested in how would you treat that kind of an investment portfolio that isn't really very active. You know, we're not going to be doing a lot of trades on a regular basis. We've got roughly 8 million or less, depending on the year, that we can actively work with. We'd like to see something on the order of 2 or 3% at a minimum in terms of, you know, returns on whatever we have invested. So that's what we're primarily interested today. And right now you've got about 2 minutes to talk about that.
I'm going fast. Don't worry, I'm going to make it. If you look at page 5, first of all, we have many clients that are what you just described. To give you some sense, we have about 350 clients. Half our clients are under 13 million. So in other words, we have some larger clients, but in reality, the base of our firm is essentially almost under 10 million, which is essentially where we are. And so we cherish all of them. And again, we are a high quality manager, which means first and foremost, don't hurt the client. Second, we only buy treasuries, agencies, corporate bonds rated single A minus or higher by 2 rating services or higher. And we take no leverage. We never do anything of that nature. And we never buy any derivatives. We never do any of those things that would get us into trouble. And that's by design. So there's never going to be an oops. And for us, we have many clients that do exactly what you're saying. We have many that will have significant flows, almost daily flows. We have some that never have a flow. We have some that want to see us or have a call with us every quarter. We have some that say, I'll call you when there's a problem, there's an issue. And the first thing we would do was sit down with your staff to really make sure we understand the cadence or the rhythm of the flows. This is what we always do. Is there some sort of cadence where it goes higher and then it comes down as you draw it down? Or is it sort of a corpus that stays where it is? We would work with the staff to make sure you have all the different cash flows. We would project them out for you to make sure we can do it. And we would agree on an index that works for you. Right now, we use a 1 to 3. When I looked at your attachment A, there were many securities that had up to 5 years maturity. That sounds a lot like a 1 to 3. The index is 1 to 3, which has a duration, which is an interest rate sensitivity of about 1.9. We typically operate about plus or minus 20 or to 30% around the index duration or interest rate sensitivity. We could do something that's tighter, or we could do something that's looser, depending upon what y'all need and what the staff needs. Based on where the current levels are today, I think making 2% is something that is more than achievable. And in fact, we believe in active management, but we would really hold your hand and hold hands together to make sure we didn't do anything that you weren't comfortable with. We've been able to do it. I'm going to go to page 6. In the interest of time, I won't go through it, but you can see the performance. It goes back some years. It's a 1 to 3 as a government index where we can buy corporate bonds opportunistically, which means very similar to Exhibit A. You can have some, but don't get too many. And you can see how it would be invested today on page 7. You can see where the portfolio of a typical portfolio that's in this strategy is on the left. The index is on the right. Our average duration right now is about 2.6 versus the index of 1.9, which means we're a little bit longer, about 7 to 8 months longer than the index. You can see our average coupon's a little bit bigger, and you can see our yield to maturity is a little bit higher. And it has worked because having a higher current income over time is your best place to outperform net of fees to achieve that 2% objective. I know I went fast. I won't go through the commercial in 8 or 9, but those are the commercial because we're good citizens. So know that we care about the community, and we do that with our time and our treasure. We're ready for questions.
Does anybody have one?
No, I
think we have everything we need. Actually, out of time too. I'm sorry, apologize for the, I should have time, but anyway.
No apology necessary. Thank you for the time that you gave us. And in closing, you know, y'all are important to us. And the reason is because I know everybody says that, and I hear everybody say that to me and to Ruby, but we're trying to expand our footprint in California. We have not had too much success. We're never going to give up. I don't know if it's because of geographic, we're not able to get there as often, but we're trying to expand. You know, we manage money for the city of Los Angeles and some others, but in reality, our footprint is not, in our view, where it should be in the state. And so that's why it's of keen interest to us. And we're here for anything that you have. If there's any follow-up questions or anything, a follow-up presentation, we're ready for you.
All right. Appreciate that.
Thank you, Gilbert.
Thank you very much.
Thanks so much.
Thank you, team.
Thank you, team.
Bye.
Thank you.
Let's see.
It's late in Houston. It's already 7:30.
Yeah.
All right. So is everybody undone from the?
That was it. Yeah, nobody's.
I don't know how we want to proceed on this. I've got my opinion as to who I would choose. I don't know if just not trying to make a resolution today as to who we're going to pick, right? Are we?
Well, we're not doing the picking. We're doing the
just
recommendation to the full board.
Right, the full board. So I don't know. Well, you'd like to, and I.
like, why don't you put
Okay,
your?
well, I can go first. I think, the problem with McQueen that I saw is I actually liked his presentation, but he jumped on the idea that we didn't have a ladder. And I kind of thought, people may not say we have a ladder, there's a ladder. And so, he was looking for something that would practice. What I did like, the optimized investment partners. And the reason was, they started right out on what we would need to do, and that is build a model of our annual cash flows with some history so that we know when money's coming in, when money's going out, what the projections are, and that sort of a thing. And that to me is fundamental need for, managing our money. The fact that they started right out with that was to me very impressive.
More practical.
Yeah, it was, this is what you'd have to do to really be able to set up a true investment plan. And I like that. The US Bank Private Wealth, talked about what great returns we're getting with PFM. The reason we're having this meeting is because we're not getting great returns with PFM.
Fair enough.
And all he said is we're going to do the same under a different group of people and charge the same amount of money.
Charge the same amount of money.
So I appreciate the fact that they're a big bank and they have a lot of research capability and all that stuff. They're not focused on agencies such as ours, which IP is. That's what they said. They're fundamentally and basically government type organizations such as ours. And so even though they were small, they only had 30. I thought, that they're doing what we need to do with other groups. And so I like that particular experience.
OIP didn't say we didn't have a ladder. They said the ladder that we have is too short.
And that's fine, but it's just, again, they would build a model of what we do, our cash flow works. And, I was kind of also back to PFM. We've never seen anything like that. Have they ever requested to actually build something like that we could look at as
And
a?
I've asked, I went down and asked them and like you guys to help us do a cash flow analysis and.
Got no response. Yeah. So
They said
they
we're
went,
brokers, cash flow analysts.
yeah.
Well, it was, we can do it, but it was like, but you tell us what it is. Tell us your cash flow and then we're gonna call it.
Show us your cash flow analysis. Yeah.
That how that relates to actually reinvesting is
Yeah.
two totally different things.
Yeah. So I was given as just a subsidiary or a partner or a daughter or a sister or something. I was not really anxious to go with them again.
Right.
These last people, they spent whole time talking about personal stuff and it's all great, that's great. It's a success story, but it had nothing to do with what we asked for. I didn't think. And in the end, it was kind of, we'd sure like to be in California. Okay. They didn't really have a lot to say about exactly
Why they should be.
the kind of experience I wanted to hear about that they have had with government agencies or, special districts or anything. It was completely absent. So I just wasn't. So if it were me, I would go, the other reason to think about this is McQueen was 0.19% as near as I could read from their fee schedule. OIP was 0.1%. West Bank is, as we know, 0.4 for 5 million. So we know that's 25,000. So
That's 20,000 right
yeah,
there.
so it works out to about 3 to 4 times what the other two, at least 2 to 3 times what the other two proposed. And the last group, as near as I can tell, is 0.1%, which is in, it's a reasonable range. But again, there was no.
0.14 AUM.
It kept referring to page numbers. And I
Yeah.
didn't see anything about.
No.
It was
We
like
had
the
page
two.
numbers and their proposal had page numbers.
And then none of
Two
them.
different documents. They may have, I mean, I didn't get a
Didn't understand
presentation,
that.
but.
It wasn't worth fussing out.
No.
Anyway, if it were me, I would recommend OIP. They're focused on our type of organization, have the lowest fee schedule of anybody, and the types of investment choices they would make are no different than anybody else. It's just how they would organize it, how they would structure it, based on a model of our actual just say performance and needs. So that would be my choice of the four.
I wanted to like Garcia Hamilton, but it became clear to me at the end of the discussion that they had not looked at our income cadence, if you will. That we get most of our income in two chunks, 3 months apart. And we have to live the rest of the year with the commercial accounts that we do bill monthly, but that's not a big chunk of our income. And I would have thought, and one of the others, I can't remember if it was US Bank or McQueen, I don't know which one it was, said we looked at your packet from March. We could have looked at May, but it doesn't matter so much. But to understand where our income comes from, it's all in any one of the monthly reports. And the last group, I think, never looked at it.
That was my impression too.
Yeah, and US Bank, they're so big, when I read their proposal, it looked like, well, first of all, we don't talk about private wealth management to a public entity. That's not what we're about. And so, I mean, I don't remember exactly, but I think I saw stuff about estate planning in there. And it was clearly a canned response that did not apply to this district.
Are you inferring a swing and a miss?
Swing and a miss.
I think he is.
Yeah, and I was struggling with that because I wanted, they were spending all their time talking about their personal histories. And I wanted to be polite. I also wanted them to stop, get into what we needed to know about. And so I was struggling with, I keep letting them talk or don't,
Well, usually it's best to let someone hang themselves or
They
succeed.
did, yeah.
And that's, the nature of a presentation. Been involved in a few of them myself.
Well, I don't think I was
It's
blunt with them, but I didn't want to go
no,
on with
you
them.
actually were,
You were appropriately
was
blunt.
trained.
Tell my wife.
Yeah.
All right, so it's just you and I because you're technically a member of the
I am
public.
just a mere chicken
That's
plucker.
right. So it's you and I as to what recommendation
Kibitzer.
we would suggest we send up to the board.
I would say OIP would be my first choice. I'm still not quite sure about McQueen.
I would submit that having a 1 and a 2 is good enough. Out of 4, you've done this. You've done the adequate filtration and screening.
No, OIP, like I said, went directly to what we would need to do to fit, right off the bat. They didn't spend a lot of time.
Well, I thought McQueen largely did the same thing, but may not have understood that there is a staff-derived cash flow model also.
Yeah. All right, well, we don't need to vote on that. Do we just?
So,
say-
I wasn't
yeah,
here.
so would the recommendation be to bring certainly OIP for the board for a consideration? I presume this would work for the board. So it'd be appropriate to bring OIP for an interview for the whole board. Would there be a consideration for bringing a second, or are you only interested in just one presentation?
It's kind of up to you. I mean,
Yeah.
I'm indifferent to it.
Yep.
I think, again, I
Well,
think.
I think
Definitely don't have
Yeah, you don't have to.
probably my first choice. Since we both agree on our first choice, it may not be fair to a second bidder,
In their time.
bring them in. So, yeah, I would say recommend OIP to the board.
You can, if the interview with OIP doesn't go well,
Let's do it again.
Yeah. Then,
then there's always the next board.
right,
Okay, so beyond that, we're going to switch partners, so to speak. Call the divorce, but are there considerations that we have to make as a district, penalties or whatever, that how do we transfer that portfolio from PFM to OIP,
So-
assuming that's it.
I've done a little research and my understanding is that we can maintain US Bank as the custodian of the long dated bonds that the district still owns. So in essence, US Bank would remain the broker and OIP would direct accordingly.
What piece of the action does the bank get for
That's my
custodial?
understanding.
I think it might be something too to discuss if we format it in the interview and then essentially a subsequent selection, and then the board can staff to talk. It may be fruitful even to just transition everything because the expense is so high. So it's something they can help us evaluate dollar for dollar if that's even
that makes-
beneficial.
Yeah. But they may be able to use them. I don't know.
Yeah.
I think it's a question that when we have this conversation and we broach it for them, we say, hey, take a look at this. We'll give you what we'll get you what.
That's the question of how they would
Yeah.
process the transition rather than us trying to figure it out.
That's.
Might be something that question board meeting, please.
And is that something we should ask PFM? So
Yeah, I think it's reasonable because
they would do that, because I can see a case where here you have new company, presumably there's some sort of new account set up with them. The old account, maybe the broker, but the thing comes due, so the money's free to reinvest. Do you have to go through the existing, or can you put money into the new account, have them
I
in
think it's US Bank.
it? And there may even be tax consequences for doing that. I have no idea.
I mean,
We could be getting into something that's really a bit more complicated. And so those are good questions to ask.
this isn't going to be foreign to them. I mean, this is commonplace. So they'll have some strategy, a very easy answer, I'm sure. And luckily there isn't a lot of money tied up like that anymore. So I don't think it's an enormous
The
concern.
remaining bonds, you mean?
Yeah, very small amount of. still blocked out relative to the-
I'm curious about one thing
This meeting.
that goes beyond these four bidders. And that is,
So we probably need to.
we need to adjourn.
Well, no, we've got 8 more minutes.
Yeah, but we have.
Yes, you did.
Set for the conversation, so now it's.
Yeah, Brown Act. Okay, well, with that in mind, we'll tell the staff that we'd like to have OIP come in in a more lengthy discussion with the full board. During this finance meeting at 5:02.